Welcome to Think Aside. Imagine if you could control the markets. If you could have this magic button that you could say, markets go down so you can buy, markets go up so you can sell. And meanwhile, you're making profit with every buy and sell, specifically with your sales, of course. Imagine if that was possible. How easy would it be to just have a bunch of money? What if you didn't have to tell anyone that you had that button? Or rather, you could disguise that button as something else. What if you didn't have to say what you purchased and what you sold? Well, that's pretty much what the Federal Reserve does. Imagine that imagine that you could do what the Federal Reserve does. So let me explain what I mean by that. The Federal Reserve is able to control a few different aspects of the economy, and they have different tools to do that. And the purpose of that is to control inflation. So, one of the tools that they have is to raise or decrease the say increase or decrease the interest rate on loans, right? Seems harmless enough. Well, the purpose for that is of course to either encourage people to take a loan or to discourage people from taking a loan. Because we are in an inflationary environment, in order to grow, you have to take debt, right? You have to take money out. There needs to be more money in the economy to encourage growth. That is the mindset of the economy we live in. So, sounds fine, but so imagine, they raise the interest rate and fewer people take out loans, right? And so then what happens is those who do take out loans, there's more money going in than what was given out, and so that way it kind of decreases the amount of money in circulation. Vice versa, it would put more money in circulation because they decrease the interest rate. More people are taking loans. They're putting more money into circulation, and less money is being returned because it's a low interest rate. So now that sounds simple enough and fair enough, right? So imagine the catch here is kind of what we talked about before is imagine having that magic button, except for while you're doing that, you can invest in the market. And so this is how that plays a factor, why it matters that they can do this. Specifically in this case, it would be Jerome Powell is a person, he's an individual, he can privately invest. But the catch to this is that not only can he invest in the market, but then he can use his magic tool to increase or decrease the interest rates. And so let me explain how the interest rates directly impact or subvertently impact the markets. So when you increase the interest rate, bonds become more valuable. So people who are trying to retire, people who are trying to build a portfolio to invest in, and they are trying to, of course, save money, preserve the value, just like we've talked about before, just like most people do, or most people who invest. The point is to preserve that value and increase that value, so that way they have the money when they retire or when they want it. So you increase the interest rate, which and then increase the value of bonds. So people buy bonds. That's part of their portfolio, or it could be potentially the majority, being that that is one of the lower risk but high reward assets. So they buy those. And then all of a sudden, while the majority of people who are, planning for retirement and things like that are preserving their value of their money, are into bonds, say the interest rate gets dropped real low. Now those bonds are near worthless or worthless. And so what happens then is any proper investor, anyone who knows anything about their investment portfolio is going to see that, okay, well, there's still some risk here with the bonds, but yeah, I'm not accruing any interest. I'm not accruing any sort of real return. The return is less than if I go into stocks because the interest rate is low. And so people want that return, so they put their money into stocks. So if people put money into stocks all at once, right, more people that have money into a single stock, the value of that stock is going to go up because the market's going to see more buys, and so the demand is higher, and so the bid or the ask price for it is going to go up, right? The bid and the ask actually is going to go up. because people are going to start wanting to pay more and people are going to have to pay more. And so when they do that, of course, it increases those stock prices. And then what happens is people have to, again, they have to buy these stocks for more money with the same return, roughly, that they would have gotten if they had bought it for much less money. And so then what happens is the reward isn't as great either. And so then eventually what they'll do is, of course, when they lower the interest rate or when they increase the interest rate again, then it goes back to bonds and other assets like that. And so you see, and that's where that cycle comes in, is people move their portfolio around depending on where the interest rates are and where the economy is at. Interest rate being one of the biggest impacts to that. So now imagine you're the person controlling this, right? You're the person with the button that's saying high interest rate, low interest rate. Meanwhile, you're investing your money into the market or into bonds, depending on what you're going to do. And so, say you're like, okay, well, I'm going to lower interest rates. I'm going to bump up the stocks. But before I do that, I'm going to put $200,000 into the NASDAQ or the S&P 500 index, just general, or maybe a specific one, right? Buy a handful of stocks. I'm not going to tell anyone or whatever. And I'm just going to, do all this. And then I'm going to go ahead and I'm going to decrease the interest rates. I'm going to decrease them now. And so all at once, people are buying into stocks and the prices are going way up. But I bought them at real low and I knew that they were going to go up because I was the one that made them go up. And so then they go up and I sell. And then I say, okay, well, I'm going to go ahead and lower them again. And maybe maybe in real case scenario, they're not directly saying, okay, well, I'm going to do this for a personal benefit. But even if they're doing it for the economy's benefit in their mind, they're still choosing to privately benefit from it and they're directly impacting it. And so they know that they can benefit from it with very little risk, if any, being that they are literally controlling that environment, that the manipulating the market, the economy, right? So it doesn't matter if they are directly doing it because they want to make money or if they're doing it because they have to but making money from it. Doesn't it still seem unfair? And I use that lightly because I'm not a huge fan of saying the word fair or unfair. Life isn't fair, and everyone has a different chance at different things and all that good stuff. And but for one person to be able to manipulate the market the way that he can and say have a conversation on the TV and say different things and it directly impact the market for people to trade according to what someone says and not even does. That's a lot of power. It's a lot of power for one small group or one person to hold. And we willfully give that to them. And the majority of us aren't aware of what's going on. We aren't aware of the power that they truly have. Just from the little bit I've said, like, I don't even know the half of it. But even that one aspect to be able to benefit greatly monetary wise just from saying a few words, not even actually doing it, and then to do it and benefit even more. Isn't that absurd? That's a king, is it not? Saying what they want to get their way, to get the things that they want, the things that they need, to effectively steal from the general population. They say that the wealth divide and the inflation doesn't cause the wealth divide, that it's not impacting it or very minutely. But when you look at that, the general population, if you're trying to, invest for your retirement and then they pull shit like that, and then you're not fast enough, and next thing you know, the stocks are way too high for it to be worth your money as well. Where's your money going? You're cutting it in half. Meanwhile, he's taking it because he was in early. They were in early. Anyone who knows was in early, right? And that's the whole point is people follow those words because they want to be in early as well. And so they're trading to his words, the things that he's going to do, the Federal Reserve is going to do, Jerome Powell is going to do. They have to. It's like If I had a loaded gun with one bullet in it, and I get to decide when I put the bullet in the chamber, right? When it's a revolver, and I decide when it's actually ready to fire, and I say I hand you a shield, a bulletproof vest or a shield that's going to stop it, right? And I say, "Okay, I'm going to shoot now." Are you going to hold up that shield regardless of if you believe me if that bullet's in there or not? Of course you are, because you got to protect your life, right? So you're going to hold it up. And I might dry fire, but it was worth holding it up because what if it was a real bullet? It's the same idea. You, people have to buy and people have to sell according to what he says, because if he actually does it, they're going to be impacted the way that they suspected. And so they have to prepare for it. And if they don't, they might get shot in the head. They might lose everything they have just because one person decided to benefit or to manipulate the economy the way that they saw fit. That's what the Federal Reserve can do. That's the power they have. That's a portion. That's only a portion of what they can do. So think aside the idea that the Federal Reserve is actually doing us something good, that they are here to help inflation, that they are here to help with the divide with employment. Of course, they want people to be employed. Of course, they want them to give 40 hours of their life a week. Why wouldn't they? It keeps you docile. It keeps you tired. It keeps you doing shit that you don't want to do. It keeps you doing what they don't want to do. you know, if there were a bunch of people living their life and making money off the stock market, if it was that easy, who's gonna work at McDonald's? You're not going to. I'm not going to. I'm not gonna do that stuff. Why would I? If I'm doing just fine, if I can have a piece of the pie that everyone else has, if it's shared without one person cutting it the way that they want to. If we all get to decide how we cut it, it's going to be a little bit different, huh? It's the same idea. Don't give one person, don't give a group of people, don't give any one entity centralized power. Because that's how it goes. They look out for themselves first, and then they look out for what benefits those that aren't them. That still gives them incentive to look out for them. And then they look out for those who don't matter, if they even look out for those people. Right? We see Social Security and we see, okay, well, they're helping us because we have Social Security. They're just printing money. They're not doing anything. They don't care. That little bit they give you, all it's doing is devaluing the dollar, and then they can spend the money before it devalues anyway. It doesn't matter to them. They're not doing you anything good. They're not doing you a service. It literally takes nothing from them. Think aside. Have a good day.